Just a quick reminder, this podcast may contain general advice, but it doesn't take into account your personal circumstances, needs, or objectives. The scenarios and stocks mentioned in this podcast are for illustrative purposes only and do not constitute a recommendation to buy, hold, or sell any financial products. Read the relevant PDFs, assess whether that information is appropriate for you, and consider speaking to a financial advisor before making investment decisions. Past performance is no indicator of future performance.
Hello and welcome to episode 2 of Stocks Neat, a Forager Funds podcast where we talk about stock markets and review a few whiskies. I'm Steve Johnson, Chief Investment Officer here at Forager Funds. I'm joined by Gareth Brown, who's a portfolio manager on Forager's International Shares Fund and also our resident geography expert, knows every mountain, river and capital city in the world. Welcome, Gareth.
Hi, Steve. Hi, everyone. Happy New Year.
You've just been adding a bit to your geographical knowledge of Australia with a trip down the south coast. For a bit of background for people, Gareth was originally planning in Christmas in Austria with his in-laws and a number of changes of plans.
Yeah, we ended up cancelling that trip and then thought about Fiji for a while, and then we thought about Queensland, and we settled on Tathra on the south coast of New South Wales, so we didn't have to cross any borders. So we actually went into Canberra for a few days, which was lovely. Haven't been there in the downtown part of Canberra for years. Took the kids and showed them all the sites around the capital, and then we had a week down at Tathra, which is a nice spot, sort of basically an hour north of the Victorian border. Lovely area, and yeah, it was a good holiday in the end.
Very nice. Welcome back. And
it certainly sounds better than your last couple of weeks.
Yeah, absolutely.
How are you doing?
I've been struck down with the old coronavirus and had a bit of a worse bout of it than most people that are getting this latest Omicron variant. My first week so I tested positive on the Monday. I think I got it at the Sydney Test match at the cricket on the Friday before, tested positive on the Monday. And that first week was like everyone else has been talking about, pretty mild symptoms. I didn't really have any runny nose, slightly sore throat, bit of a cough. And by Friday night, I thought I was completely better. And then I woke up Saturday morning and had a really bad headache. And I was chatting, my mum called me last night to see how I was. And she said, when you're a child, you had a lot of sinus infection issues. If there was something that was going to go wrong with you, it was always going to be your sinuses. And I think that's what's happened here is the virus has actually got into my sinuses, a lot of pressure behind my eyes. Then the Saturday, Sunday, the Monday was probably the worst of it. So sort of a full week after I first tested positive. Feeling much better now and on the straight and narrow, and yeah, hopefully get a short little trip up the north coast of New South Wales in myself over the next couple of weeks.
Fingers crossed.
We'll come to the taste test later on, but what whiskey are we trying today, Gareth?
This was sent to us by an investor in the fund. It's come from the Corowa Distilling Co, which is a town on the New South Wales side of the Murray, a little bit downstream of Albury. It's probably 100 kilometres downstream. It's not a small distance. It's called the Barrel House is the type of whiskey that they have. So it's a single malt, which means it's come from that one distillery. Aged in American oak ex-bourbon barrels. So those barrels have been used to make a bourbon in Kentucky, and you're only allowed to use a bourbon barrel once, or else you're not allowed to call it bourbon. So they ship it off to the whiskey world. So this particular barrel's moved all the way down to Corowa and been used to age this whiskey. It's 48%, so it's a bit punchier than most commercial whiskies, which are around 40. And I think it runs about $120 for a 500ml bottle. So it's sort of mid-priced, I'd call that.
Yeah, there's a burgeoning little scene here of Australian whiskies, so I'll be looking.
Yeah, it's great. And on the mainland as well, Tasmania sort of developed a while back, but it's good to see them on the mainland as well. And if I have one complaint around the Tasmanian whiskies is that they've just gotten so damn expensive. Most of them are sort of unaffordable. This sort of fits in it's not cheap, but most people can afford it if they want to give it a try.
I'm not going to try the alcohol myself today, given the sickness of the past couple of weeks, but you can drink for both of us.
It smells like it's going to taste very smooth. It's got a bit of maybe vanilla. I poured a double because you're not drinking, so It is after 11 here, so we can do that.
The other big event while you're away, well, I guess it started while you were still at work, but has accelerated over the past few weeks, is this sell-off in small cap stocks around the world. It's got pretty dramatic in the first couple of weeks of January.
It's probably not small caps anymore either. It's various, well, pretty widespread. So we've been going through our portfolio. Obviously, the median stock. So we own about a 40 stock portfolio. The roughly 20th stock in the portfolio is down now 27, 28, 29% from the 52-week high. That metric is a bit distorting because stocks tend to hit their highs at different times and they're always below their 52-week high, just about. But that's the median stock in our portfolio. And we've got nearly 10 stocks that are down more than 50% from their 52-week high. Now, those stocks are all stocks that we did well out of in the sort of first half of 2021. They've given back a lot of their gains. In most cases.
When I put the quarterly report together, I think we returned 15% in the international fund, which was under the index in 2021, but perfectly acceptable return from investing in stocks over the course of the year. But that was 6 months of crazy positive outperformance, and then the back half of the year, I think, was negative 13 or 14%, and that was with a bit of currency tailwind as well. So the portfolio is actually off more than that in local currency, and we had sold vast amounts of the things that had done very well for us. So as you touched on there are a lot of stocks down 50% in our portfolio, and that's pretty consistent across the market as well. The Australian market, I don't think, was as extreme in terms of that small cap valuation, but you look at that buy now, pay later space, and it's been a complete bloodbath. Cathy Wood's ARC Innovation ETF's probably the flagship for high growth investing. The price of that ETF is $160 down to $70 something. So it's been very, very widespread pain out there. Any lessons for you? I wrote a few things in the quarterly report that I thought I'd picked up through this, but any lessons for you first in that? And then maybe we'll come to the coming reporting season and opportunities as well.
There's no doubt we've made a mistake here. We had a very good period, H1 21, and we were aggressive. All the stocks almost all the stocks are up the top of that list that have performed the worst for us over the last 6 months. We had been aggressively selling them from, April, May, June last year. And often we've sold 60, 70% or more of our initial holding. I think the lesson, with hindsight at least, we should have sold the lot, or at least, kept selling more aggressively. Inertia is a powerful thing, and sometimes you just need to when you're directionally, you're doing the right thing directionally, you just need to sit down and think, should I be pushing this harder? Because ultimately it's cost us owning any of these sort of stocks.
Yeah, I described it as steps in the right direction, but clearly not big enough. And I think that's true of the things that we were looking for and talking about on the other side of this as well. Tesco has done quite well for us. Lloyd's has done very well for us. Those, I guess, more traditional value type stocks have been performing quite well in this environment, and they were very, very, very cheap. And, we bought them, but we have 2.5% positions there, and they've been the same weightings, but less of them as a lot of the other stuff as well. Look, I think there's a lot of people that were new to investing over the past 10 years, made good money out of a lot of these growth stocks, and are probably sitting there feeling a bit of distress now. I think it's a really important time to go back to the fundamentals. You are buying a business here, and just sit there and say, forget about all of these ups and downs in the share price movement. At today's price, is this a really good business for me to own for the next 10 or 15 years? And I think it's going to be a really interesting reporting season coming up for us on that front. Some of these businesses that we own, we've been very, very happy with the progress with, but they are relatively young, relatively new. 2022 is going to be a big year for them, proving up our hopes for those businesses. And I think if they do, from these prices, we were, you're right that we've made mistakes, but we were sitting there saying, it is often a mistake to sell businesses where the performance of the business is going really well. A lot of them are performing better than we had initially anticipated when we bought them. So if we get delivery over the next couple of years, they're businesses that I think can generate fantastic returns for us, whether or not the share price goes up.
Yeah, I mean, the first leg of this sort of, I guess, going till Christmas sort of made sense. We had a fairly stretched growthier end of the market, and some of these things needed to fall and probably won't recover quickly, but it is getting a bit indiscriminate. So there are opportunities there that are looking particularly juicy, I think.
Yeah, and look, that's historically what we've done well, and what I want us to do well again is when these things get silly, stop worrying about the directional movement in the share price and start worrying about just finding businesses that can get to absurdly attractive prices. So looking forward to those results coming out over the next month or so, and there'll be lots of guidance this time around for 2022 results. Speaking of doing it tough, 2021 was a really difficult one for the Australian funds management juggernaut Magellan. This is a funds management company here in Australia with $100 billion of funds under management, and the management company itself is listed on the stock exchange as well. It's been an amazingly phenomenal success story over the past decade, and this 2021 has been a very difficult period. Some big bets on China stocks that didn't pay off, a significant amount of cash held through March 2020, thinking that things were going to get worse that didn't. In the space of the past 12 months, Magellan's main fund has unwound 10 years of outperformance and is now under the index over 1, 3, 5 and 10. And I think for a lot of people that have invested in the management company out there, they've seen that the share price of that management company fall some 60% over the past year. So I think an interesting business for us to take a quick look at. One we've got some history with, and a business that we both work in. So maybe we can provide some insight there. But maybe to kick things off, Gareth, you've got a small personal history with some of the people here, and some of I think the media and the coverage of the saga over the past few months has been quite ugly and disappointing.
Yeah, the term that comes to mind here, Steve, is tall poppy. I get it; it's a national sport, but these two guys have built a very, very successful business that they started, effectively from scratch, 15 or 17 years ago, or whenever it was. I've met Chris a bunch of times over the years. Chris Mackay, that was one of the founders. Hamish, I've only met the once, but it must have been 2005, I think, if not 2007. Greg Hoffman and I recorded a podcast with both of them down on the banks of the Missouri River in Omaha. We were all over there for the Berkshire meeting, and they were obviously intelligent, and they talked about what they were going to do and high quality businesses. And then Hamish made a comment. He said, "We're going to gold plate this organization. We are going to get the best analysts, the best back office. We're going to do this from day one to build." I don't remember if he used the word platinum, but that was sort of the impression I got. And Hoff and I both looked at each other, and I'm sure there was some sniggering there. That who's this guy to say he's going to build the next platinum from scratch? And they just got there. They had their plan. They did it. And I can't have anything but respect for what they've done there. So yes, the stock's off 50%, but they've generated an immense amount of wealth for their shareholders, for themselves. I just don't feel like I'm in any position to criticize. I actually think that I owned platinum shares back then at the time, and I think I do still own them, and they've gone backwards slightly over 15 years. And these guys have gone and built a business that's maybe not made them billionaires, but close to, and a lot of respect for them.
Even ourselves, we bought Intelligent Investor. You and I were part of the group of people that bought Intelligent Investor back in 2004, and I think I calculated we're roughly 0.5% of the FUM of Magellan, and they started around the same time. It has been an amazing success story. I want to be
Hamish. It's just not what we get out of life. But they've set their plans and they've done it, and I think they've done it in a way that's generally added a lot of value to investors. So yes, we can sit here and say they've done no better than the high quality index, but those investors in 2005 in Australia weren't going and buying an ETF of a high quality index. They went and bought this instead, and I think they've served their clients, really quite well, and they've made a lot of money out of it. And I just don't feel like I'm in a position to criticize them on any particular matter.
And I think for anyone thinking of starting today or investing in a funds management business, the economics can be amazing, which we'll come to in a second. But I think Hamish and Chris recognised at the start here that the world was changing in terms of how you build a funds management business, that the regulations and the compliance and all of the other things that you need to raise money over and above performance were becoming increasingly important. There was a day where you could start a funds management business in your bedroom, you make money for people, and then you raise lots of money. I think we live in a world now where A, you just can't do that because you need the licensing, you need the compliance, you need the capital to get started. But B, people are they want to do a lot more work on your business and the depth of your team and the amount of capital that you have. You need significant amounts of money to build a large funds management business these days. And they recognize that very, very early on. Just looking at the balance sheet here, it was something like a $30 million raise at the start, which we thought was an extraordinary amount of money. It's now a $3.6 billion company. So they have created an enormous amount of wealth. And we shouldn't, as Australians, be sitting here knocking them. A lot of this funds under management is offshore. There's tax dollars being paid in Australia. I think they've made international investing accessible to a large percentage of the Australian population that probably wouldn't have done it. And that global market return has been double what you would have got on Australian equities over the past 10 years. But look, we analysed lots of businesses that we couldn't run, and I think we do have a bit of a front row seat here in terms of running a funds management business of our own. What are your thoughts in terms of, I guess, the nature of these types of businesses? And now that the share price is off 60%, would you be looking at something like this if you were working in the Aussie market?
I don't work in the Aussie market, and I don't look closely at Magellan, but the answer is yes. Looking, not investing. I haven't made a call that's, but
Just so everyone knows, Gareth does a lot of looking. His ratio of looking to investing is very, very high, which is a good thing.
You're welcome, everyone. The thing to understand with funds management businesses is that they are high fixed costs. And I use that term in a very relative sense because we know the costs march up every year and analysts come knocking for pay rises and there's more back office and there's more analysts every year. So they do march up, but they are relatively fixed versus a lot of other businesses. And what that means is if you double your funds under management over a very short period of time, your costs are not doubling. And so a very high percentage of that starts dropping through to the bottom line. And so most funds management businesses, you would call them fair to middling sort of businesses. They're not particularly attractive, but there's a few giants in the industry that have just been able to keep their costs down really low and generate a ton of revenue because they have a lot of funds under management or because they're getting very good performance fees. Platinum comes to mind, even despite current woes. Magellan comes to mind. These guys can end up with sort of 80% profit margins.
So last year, Magellan's EBIT margin, so that's the percentage of their revenue that's profit before they pay taxes or interest bills, 84%. So 84 cents in every dollar of revenue is dropping through to either the taxman or shareholders.
If you pay them $1,000 in management fees and performance fees over the year, they're paying $160 to their staff, to their sales team, to all the other hanger-oners, Bloomberg and every other cost. And 84, was it?
And
84's drop.
Yeah, and that's a gold-plated funds management company. So, the economics at scale can be extraordinary.
And so what that means is you have really high drop-through rates. So when they're growing, the profit grows immensely and goes through to the bottom line. But when those big guys start shrinking for any reason, their revenue line starts shrinking, then you sort of like, okay, wow, the economics of this change dramatically on the downside pretty quickly too. They'll be profitable, but are they worth the same billions of dollars?
Yeah, and that's what I find really hard is the directional. This business is now a 10% fully franked dividend yield if they can just keep earning the profit of last year. I find it really hard to work out directionally which way that is going to go. They've already announced that they've lost their largest client, which was 20% of the FUM, relatively low fee, but that's $20 billion out the door in funds under management. And my experience of these businesses has been the sentiment takes a long time to turn, and then it lasts much longer than you think it's going to last.
And
as well.
allocators, they look at other allocators are doing as well, right? It's sort of all of a sudden someone big leaves, you as an allocator have to justify why you haven't left, I guess.
Yes.
And I think that just getting back to the economics here, like you have a cost base here that somehow looks like a toll road. So it marches up a little bit each year, but it's fairly flat and fairly fixed. The revenue line is much more volatile than a toll road. So it can be very difficult here to work out, what's the right price. It looks like a 10% yield, but if they lose 30 or 40 or 50% of funds under management, it's sure as hell not paying a 10% yield this year,
I think the other thing on the retail front that we have experienced that's worth thinking about if you are looking at this business is that a lot of people are still invested that are not happy at a point in time when you've been performing badly. And you sit there and think, and I've seen a lot of, there's been media out this week, Magellan's December performance was outperforming the market. There's a lot of people that sit there, wait for the bounce and then sell. That they're looking for the recovery first, but they're still of a mind to exit. So I do think that the outflows here can last a very long time. And we've seen, Platinum, like you said, been trading on a big dividend yield for a long time. It's been consistent outflows there for a very long period of time. I do think one difference here is I think Hamish is as much an entrepreneur as he is and a business operator as he is a fund manager. Whereas I think Kerr Nielsen at Platinum really was fascinated by stocks and all he wanted to do was pick stocks and was quite an introvert, was my experience of him. I think with Hamish, you've got someone that really, really wants to and has a very successful track record of building a business. And I wouldn't bet against them building things here that people haven't even thought of at the moment. I think Barrenjoey is probably going to be a success itself. It's basically transplanted what was a very, very successful UBS business here in Australia across to a new entity. My guess is that's going to go.
We didn't talk about this, but both Hamish and Chris were UBS alumni, so it's they know the business well. I'm sure they know the key people well. That's why they're probably being part of this Barrenjoey setup.
Correct, and I was fortunate enough to work at both UBS and Macquarie in my formative years, and I think those two organisations have a lot of the most talented people in a culture that is a very performance-driven culture, and there's a lot of examples of successful people building things elsewhere that have come out of those two environments. So I would not bet against them building things here that make it less reliant on the funds management business. And when the market cap was $10 billion, I was sitting there saying, well, it doesn't matter how many Barrenjoeys and Guzman Gomez's there are. It's not really going to move the dial because the funds management business is so big. Today's market cap, $3.6 billion. One of those things can start becoming significant relative to today's market price. So I'm a bit nervous about the core business, but I think it's going to be a really interesting story to watch unfold there over the coming years.
Yeah, I wish them all the best.
My favourite part of the Christmas holidays is always catching up on reading that I haven't got through or listening to a few podcasts that I didn't manage to get through the year. What did you do with your free time over the break, Gareth?
Free time. You obviously don't know what it's like having 3 kids, do you, mate? I didn't get a lot of reading done. I did listen to quite a few podcasts, which was nice. The one that sort of sticks out is I've been listening to the Andrew Huberman podcast. It's called Huberman Labs. So Huberman is spelled Huberman. He's a neuroscientist and a professor in the Department of Neurobiology at Stanford. Very intelligent guy. And he has this very wonkish podcast where he digs into a topic. They tend to be 2-hour monologue podcasts, and he'll do 4 of them on one topic. So you're getting sort of 8 hours of content. Probably not for everyone. This was about the one that I was listening to, or the one that really sticks out was about the brain.
Just quickly, I went for my first post-coronavirus walk this morning, and I was listening to one of his podcasts, and he was talking about concentration, what you need to do to be able to concentrate for extended periods of time. And he literally just sits there with a microphone and talks for 2 hours, and he was absolutely testing my concentration skills. I do find I drift off when I listen to his podcast.
Oh, I don't have that problem with him, but I would understand it. The bit that really caught me in this brain series was talking about neuroplasticity. So what we're talking about here is the ability for the brain to explore new topics, to integrate new skills, and I guess none of this is new to people, but children have a much higher the neuroplasticity is a much stronger thing. For us adults, it was formerly thought that we were fairly fixed beyond a certain age. It turns out that we can change our brain, but it takes a lot of work, a lot of deliberate work. It's very tiring. Whereas a kid, it's almost just a throwaway for them to pick up new skills. And this is my metaphor, not his, but I liken it to the child's brain is like the Oklahoma land rush. You are rushing out, pegging virgin territory, and here's this skill that I'm wishing to acquire. I play around with it. It sits on some virgin territory. The adult brain is more like urban infill redevelopment. You have to acquire the land, kick people off, get council approvals, rewire what's going on there to integrate this new skill in place of something that was there beforehand. None of that's like that should be fairly obvious to most people. What really sunk into me was he was talking about that this concept of a child's brain, it lasts until you're 25. So it's quite a tight range, plus or minus a year, but you're basically, your brain is childlike until you're 25. And that was sort of a bit of a revelation. I think it's very, very interesting here. It ties in with some other stuff that I've listened to and read years ago, talking about your risk management faculties, which also don't fully form till you're about 25. So
the other thing I thought was really interesting is I think we often think of it when people talk about it that we're building all of these neurons and connections in your brain, which to some extent is true, but you start with many, many, many more than you end your life with, and your brain actually takes away the ones that it doesn't need. So as you grow and as you evolve and as it works out what skills you need for the environment that you're in, it will actually take away connections rather than creating them, and use that capacity to strengthen other areas. And yeah, there's some fascinating stuff in there about people that are blind from birth using that, what is for most people the sight capacity of their brain for other purposes.
Yeah, and even things like echolocation. I don't know if you ever, the blind people that can click their tongues, and that sits in the same sort of part of the brain as the visual part of it. I guess the point here that I found fascinating is that you have this childlike brain to 25. And I don't mean that in a negative context. I mean it in a very, very positive context. It explains a lot for me. So I think understanding that you are born with a Ferrari, and for maybe the first 16 or 18 years, your parents, your teachers, there's a whole bunch of other people that are in control of it. But then there's that 7-year or 9-year period, depending if you're starting at 16 or 18, where you're in charge. You've got the keys, you've got the wheel, you've got the Ferrari. And I hate to say it, but at 25, you're trading that Ferrari in for a Kia Sportage. The vehicle is not going to be as good. It's a very unique period in your life. And being aware of that beforehand, I think, is really, really important. So my point here is what you do over those years is extremely important to who you become. And so it is a unique opportunity to sit down and work out, where do I want to go over the next 50 years, and what can I do over the next 5 to achieve that? Because beyond 25, it is going to get tougher.
And also just how much can you cram into that period of time while you're wiring your brain to just explore what you are interested in, what you are good at, how you want to set yourself up. That it's many, many, many times more powerful during that phase of your life than it is
width
later.
and depth, right? That's always some combination of trying lots of new things and then going deep on a few things. Everyone I've ever met that's excelled, or every story I've ever read of anyone that's really excelled at some area, has made significant progress in that area before they're 25. And the only exceptions I can think of is when they had great skill in some very near adjacent field and they just happened to tie together for some reason. So you look at Einstein, you look at any of the music prodigies that, and most of them are very, very, very skilled by the time they're 16 even. But I'm just saying that's a unique period where you've got control of the car, and it's a very, very powerful car, and you should really think about what you're doing with that time.
The other thing it got me to thinking about for us that are already beyond that 25-year period, you can change things if you really want to focus and concentrate it. It's hard. It's dramatically harder than it was when you're young, but it's not impossible. And he talks a lot on his podcasts about things that you can do at an older age to try and rewire or rechange things. But also as an investor, I think just reflecting on those formative experiences of your life and understanding why you behave the way that you do, how you respond to certain situations is usually a function of the environment that you were in during those formative years. And for me, that growing up on a farm and my capacity to handle stress, it's probably my number one asset as an investor, that when markets are in turmoil and everyone is panicking, I just don't feel the same level of stress that other people feel. And I think growing up in an environment where you regularly watched your whole family's livelihood float down the river in a flood, it conditions you in a certain way that brain has been wired to accept that, to move on from it, and to accept that things are going to be volatile in life. It's just the way that I grew up. And I think you can change the way that you invest, the way you put your portfolio together to compensate for some of those things. If that's not you, you probably got a lower risk tolerance than other people. There's nothing wrong with a really diversified portfolio. I know a lot of people that, know that they're liable to be more stressed and panicky in market downturns, so they just don't look. And I think that's a perfectly acceptable way to deal with it as well.
As soon as dumb money recognizes it's dumb money, it ceases to be dumb, right? You have those shortcuts. So this is a small, I presume the number of people under 25 that are listening is a fairly small subset. There is a lot of parents out here, so this is useful information maybe to give to your kids. I think the flip side of this, and again, none of this was discussed on Huberman's podcast, but I think it's right, is that this also applies to bad habits. So I think, if you're going to experiment with hard drugs and become addicted at 22, it's going to be a very different path than if you do it at age 29, trying to unwire those habits that are formed in that bit where you have, extreme plasticity. So I guess, that applies obviously to hard drugs. I don't want to tell anyone not to experiment, but addictions are things you need to avoid, and bad habits you need to avoid. And this applies to more mundane things as well, like people that don't take responsibility for their decisions or the outcomes that befall them because of their decisions. If you're not doing that at 25, you're not going to be doing it at 45. And I think trying to work on some of your bad habits as well as your strengths in that young, precious period of time, I think is really, really useful.
I think that's absolutely true. And it's true, I think, exercise and diet and I think that getting into those habits and training your brain to get positive feedback from some of those activities that are going to be good for you long term is very, very important. Speaking of plasticity, not so much in humans this one, but in animals, one of the things I read that was just fascinating over the Christmas break, the Christmas edition of The Economist has always got, it's half just the normal Economist and the other half is just full of interesting, diverse articles about weird things. And one of them was about people that have lived their life like birds. This is going to sound really bizarre, but there's this guy in Italy. I'm just going to dig his name up here so I get it right. His name's Angelo D'Arrigo, and he had built himself an ultralight contraption that let him fly around with birds for his whole life. He recently, last year, crashed to his death, unfortunately, but just some really, really fascinating stories about him actually growing up with birds, teaching birds to fly. He hatched 2 condors from their eggs and actually taught them to fly from chicks. And at the time of his death, he had almost completed teaching them how to migrate from where they need to go. He flew thousands of kilometers with birds.
What's he in, an ultralight or some sort of hand-powered contraption? I'm just picturing race around the world here.
So I'll just run you through this quickly. His very first such journey was in 2001, flying with Desert Hawks from Senegal to the Mediterranean. In 2003, he made a similar voyage with 6 endangered Western Siberian cranes. They'd been raised in captivity. He had to show them their migration route from Siberia to the Caspian Sea in Iran, some 5,500 kilometers. It took 6 months. Each evening, he chose their resting place, through storms, through all sorts of things. And then he'd introduced these 2 condors to the Andes by soaring with them amongst the peaks.
Crazy.
So anyway, just some fascinating lives out there, and apparently no interest in publicity or talking to people.
Cared for the
He
birds.
just loved living his life in that way. But also just the way that the bird's brain could learn all of the things that it needed to learn from a completely foreign animal. Very, very
crazy.
I just had one more last final thing to add on this plasticity concept. I think one of the things about being an investor is, okay, you get old, changing your brain is hard. I think changing anything about your habits gets harder and harder, but it's possible and it can be done. One of the really difficulties in investing is just working out what you do want to change, what you need to change, and what you need to keep the same. Yeah. And my cover letter in our quarterly report, which is up on our website if anyone wants to read it, but just talked a lot about that. You know, we went through a really, really difficult period with our Australian shares fund, what I'd call a value investing extreme bear market, where stocks that were lower quality businesses but already trading at cheap prices got to extraordinarily low prices. And we did a lot of self-reflection through that. And I think a lot of our clients went through the same and drew some really important lessons about quality of business, about how hard it is to pay a low enough price for a business in decline. And then 2021 was the year where all of those businesses performed spectacularly well. We had a great year in our fund, but we actually sold a lot of those stocks too early. You know, we learned some really important lessons, and I think we did a fantastic job to get through that very difficult period, because a lot of other fund managers went out of business. A lot of funds completely changed their stripes. You know, we've got a long-term track record there that I'm very, very proud of, but it would have been so easy just to swear off those types of businesses forever, and they're exactly the ones that you wanted to own over the past 12 months. And that's the hard thing about investing, is it's long learning cycles from when you make the decision to whether you proved right or wrong. And even then, it's hard to know what's luck and what's skill.
Wicked learning environment is what it's referred to. You don't get solid, useful feedback all that often.
Exactly right. Gareth, you've had a chance to try the whiskey. Maybe you can talk us through the taste and what's your view of it?
Yeah, it's really good. It's nice. It's smooth, easy to drink. There's no really strong flavors there. As I said, the nose is a bit vanilla, maybe a bit lemony even. Easy to drink. Really nice. And when I want to buy a bottle of sort of mid-range whiskey, I like the idea of supporting Australian producers, but there's not a lot there that's under $200 a bottle. So it's nice to know there's a couple out there. So thanks for the whiskeys, and that's the Corowa Distilling Company, and that's the barrel house is the type. So it's a blue. Is that a blue label, SJ?
Yes, that is blue.
Yeah. Okay, blue label. $120 or so for 500 mils. So give it a try.
We'll put a link up in the show notes. Thank you for sending that in, and sounds like a very, very drinkable whiskey. Thank you for tuning in to episode 2. You can follow both of us on social media. We're on Twitter, Forager Steve, and Forager Gareth, and Forager Funds Management, also active on Twitter and LinkedIn. And also, please give us any feedback. If you've got any questions that you'd like us to answer or topics you'd like to cover, send those through as well. Either send them to us on social media, or you can email admin@foragerfunds.com. Thanks again for tuning in. Don't forget to rate us on your favorite podcast app.